Hello, welcome to today's podcast. I'm your host, Jonathan Brown. Just a quick one before we start. I just wanted to say a massive thank you to everyone who listens to this show. When we started the podcast, we never imagined we'd start to reach the audience that we have done. And just one small favour I just want to ask before we get going. If you get any value from the conversations, please hit the subscribe button on whatever app you're using right now. It's the single biggest thing you can do to help us grow, and it means that we can keep bringing you world-class guests and having conversations that matter. Thank you very much, and let's get into it. Ladies and gentlemen, welcome to the Shepheard-Walwyn podcast. I'm your host, Jonathan Brown. Today we have a very unusual guest, Tim Moffatt, Portfolio Manager for Oakleigh Financial in Australia. Tim's going to share with us a rather unusual way of investing. Tim, welcome to the podcast.
Thank you very much for having me.
So, Tim, take us through, how does someone end up managing money for a living?
Very good question. I'm sure there's lots of ways you can come about being in the industry. I happen to be born into a family that was involved in stockbroking many years ago, and effectively during uni started with a small cap brokerage firm in Adelaide, Australia. So from that stage, well, that was, if we go right back, that was 2003, right at the very beginning, I guess, of the bull market, in particular in Australia, the very strong bull market in commodities. And we were in a commodity-based stockbroking house. So there was a lot of crazy times and money made and all sorts of things you expect to see in a big bull market. And I think from that moment, I was hooked. It just became something that I wanted to be involved in and continue to be involved in over the years. And really, that bull market and then the subsequent, I guess, to GFC and subsequent bust was what led me eventually to Phil's work and the land cycle work. I stumbled across Phil's book, and I guess here we are now running a fund and a portfolio which is specifically based on being aligned with the real estate and banking cycle, or the long-term 18 to 20 year cycle, and being positioned in the market and out of the market, subject, I guess, where we are in the phases of that cycle.
So I'm going to get into that. But you set up Oakleigh back in, I think, 2017. Is that right?
Yeah, so I've been in and around wealth management for a very long time. I had been with a number of different firms, and in 2017 I had a bit of a pivot point in terms of which way I wanted to go, and I decided the best path forward, rather than joining one of the big firms, was to effectively forge our own path. And so I started Oakleigh. We got our own Australian Financial Services license and operate standalone from any big bank or big financial institution. So really have the capacity to manage money the way we want to, rather than the way, I guess, most of the industry or traditionally it may be managed.
Interesting. And you mentioned just then in the introduction about the 18.6 year real estate and banking cycle. For anyone that's hearing it for the first time, what is that in plain English?
So if you're starting from scratch, most people would be aware that the economy has periods of growth and periods of contraction, over ebbs and flows, I guess, of good times, bad times, and in between. Like, I had recognized, and most people that have been involved in the stock market had seen booms and busts. And you knew about, when I started, it was before 2008, but I knew about the 1987 crash. My father had worked through that. I knew about the 74 crash. My grandfather had worked through that. And then most people knew about the Great Depression in the 30s and these sort of things. So you knew that the market and the economy had these big ebbs and flows. Really what the real estate cycle does is it puts a framework and a context around why that happens and how it happens, and why, under, I guess, the structure of the economy that we have now and the structure of finance, is why it almost has to happen again. Really what it is if you can break it down simplistically, and it's never simple, but there's multiple phases of the cycle, and the cycle lasts 18 to 20 odd years on average. It's not a science. Doesn't mean it specifically is 18.6 years. What that's trying to do is give you a framework to work within. But you have like an initial expansionary period from some really difficult economic times, seem to be more tepid. You get lots of pullbacks and a lot of fear along the way. Typically will last 5 to 7 odd years. Then you get the next phase of the cycle, is what you call a mid-cycle recession or slowdown. Everyone knows a recession is it's negative GDP growth. It's the technical recession, or 2 quarters. But what happens here is you'll typically see stock markets have a more difficult time of it. But the core here is the banking sector land prices don't tend to do a whole lot to the downside. And that means the banking sector doesn't come under undue pressure. You tend to have sort of shorter recessions and less severe recessions. And then that will take you through to the second half expansion, which is now 10 plus years away from severe economic downturn, and you start to get more aggressive economic expansion, more aggressive asset speculation, and through this whole period you tend to be getting a build-up of debt and debt load in the system, and that can be at a private level and also at a public level in terms of like government debt. As you work your way all the way through to the end of the second half expansion, you're now 15 plus years from the last severe downturn. Memories have faded about how difficult things are. Everyone tends to be making lots of money and is being super aggressive with their investments. Stock markets seem to be doing very well, property markets as well. And you get towards like a final peak phase, can be called a mania phase if you like. And inevitably that's followed by a longer, much more severe downturn in the economy and also in the stock market for a period of time. What that exactly looks like will depend on the debt that had been built up in the system on the way up, how much ill investment had been going on, what the government's policy responses are, I suppose, in the downturn to try and bring it all to a halt, how aggressive they are, or whether, like in the 1930s, there was a long period where they were not necessarily being super aggressive and supportive, like you might have seen in 2008. There was a lot of government support into the system, liquidity injections, which eventually turned the market after basically 15 to 18 months. Whereas in the 1930s, it took years in the context of a huge bull run before that. So I'm not sure if I overcomplicated that response, but it's basically a macroeconomic framework that we use as basically the core, most important framework. It's not the only thing that we look at, but certainly the most important in regards to whether we want to be in the market or out of the market, and what parts of the market we want to be focusing on at any point in time.
Given that your family background, and you were talking about your dad seeing through crashes and booms busts and your granddad seeing, you're going to have come across some quite frankly crazy ideas on how the market moves, and people retrospectively superimposing something on what happened and creating a pattern where there isn't one. Where did you first come across the 18.6 year cycle, and what was it that convinced you that this was something that was worth working with?
It was Phil's book, The Secret Life of Real Estate and Banking, that first introduced me to it. I mean, I'm not a real estate person at all. I'd only ever invested in shares. But having worked through the GFC and I guess survived in the industry, or I was still in the industry, I saw colleagues disappear. Most of the financial services provider they worked with they got through it, sort of shrugged it off and went, that was horrible. But eventually I came across Phil's book, but I would say it was 2012, perhaps, quite a lot later, just trying to find, I guess, an answer to what happened and why, knowing that these things had happened in the past and did repeat. And even after I'd read the book, I was still quite skeptical, but I think there was enough in Phil's book. Because it goes back over hundreds of years and it shows you what had happened previously and why, and what, I guess the outcomes you can tie to the stock market, because you can see it in a historical sense. It was enough for me to go, okay, this is super interesting. Let's just put it to one side and start watching and start going, okay, if you're following this cycle, what should you be seeing in the world next? And sure enough, over the next few years, it became apparent that there was something in this. And I guess over time, it became using the framework was very helpful for making money, I guess, and also preserving capital in later stages. And until it became to the point where quite clearly this is like very central to how and why things work. But I think the hook was, I like history, and Phil's book has a really good framework to walk you through all these historical cycles, which are the same, but I mean, they're obviously different in respects of what was happening in the economy at the time and what are the drivers of the cycle. But at the end of the day, it all comes back to one central thematic, which is land and what the banks are doing lending against land and how that money flows in and out and around the system.
So practically then, when you're running a fund, how do you apply your investment strategy based on the cycle? What signals do you look for and what changes through that period?
Okay, so in specifically regards to the 18/6 strategic investment portfolio, that portfolio has been constructed to be invested aligned with the cycle. So what that really means in a simplistic sense is we want to be invested more heavily in growth assets during the expansionary phases. So that they're the periods where the share market tends to do well. We want to be focused on capital preservation to a certain extent, knowing that we're probably, what we expect, we would be seeing more difficult times, which usually will translate to a more difficult share market. And then in the bust phase, you're going into full capital preservation mode. Now, it's never as simple as like, okay, now we need to be fully invested, now we need to be fully in cash and those sort of things. But it's about using the framework to be able to go, okay, these are the periods where we think we should be invested, and these are the periods where we think we need to be cautious with our capital. You can drill down from that level to historically in these phases, certain sectors have typically performed well. So like in the first half of the cycle, technology has traditionally performed well, manufacturing, things like that, which are, if you look at markets, the US market's certainly much more exposed to some of those things than, say, the Australian market, which is much more exposed to banking and resources and more old, real estate, more old world industries. Those industries tend to perform stronger in the second half of the cycle towards the back end. And so if you go back through history, you can kind of go like this is no magic panacea, but you can go, there's a correlation here between what performs better at certain times. And what that helps us do is narrow down on the sectors that we should be looking at more closely over time. And so over the last, say, 3 or 4 years, we've been particularly interested in resource, got precious metals, banking globally, industrial metals like copper, things like that, which Phil's got a good line, which is basically the copper price has run at the end of every cycle. The copper price has had a move. We've seen this again now, whether that's over or not, I guess time will tell. It's still holding up pretty strongly for now, but that has helped us deliver the returns that we've been able to generate without being necessarily riding the AI tech wave, which has been the major driver of a lot of the returns over the last couple of years. So if you haven't owned that part of the market, your returns haven't been anything like the S&P 500, for example. So despite we actually haven't had a lot of that exposure to tech, we've still managed to actually outperform and certainly hugely outperform the Australian market, which has really languished for the last number of years.
So you have, look at genuine dynamic asset allocation. How do you sit comfortably when everyone else is chasing after something, or if you're looking all the way back to the turn of the cycle, when you'll be heading into the market when everyone else is saying don't ever invest again, which is typically, how do you handle your own emotions in that? And then also, I guess, how do you help your clients to stay calm? I was reading one thing that you got quite a large cash position right now, which is at this stage in the market, people would normally be wanting to be fully invested and making the most of these gains, which, as you know from the cycle, and as we know from the cycle, that this is the most dangerous time to be fully invested. So how do you handle your own emotions, and also how do you help your clients stay the course and stick with the fund?
Yeah, look, it's a good question. And I think it's not always comfortable in some respects, if you don't have semiconductor stocks that have doubled and that's where all the returns are. But I guess when your core focus is around, it's not necessarily making money. Obviously we want to make money and investors want to make money, but I think those that are in the strategic investment portfolio typically have been through a cycle before, probably a lot of them have lost money in a market crash or something like that and have come across the real estate cycle in their endeavors to try and understand and not let that happen again. And so I guess the primary and the core with all of our portfolios that we look after is trying to focus on capital preservation, so above anything else. And so while that's going to mean at times we're going to hold higher cash levels, right, than the share market itself. So like even with the strategic investment portfolio, the portfolio has, I guess, a philosophy, and we're trying to be true to form with what that entails. So we've said to investors mid-cycle, we would expect to be running a defensive-ish allocation. Between 21 and most of 2022, the portfolio averaged 30-something% cash. Between 23 and the end of 25 into early 26, it was almost fully invested most of the time. Okay, so that would putting us into the second half expansionary phase. During the first quarter of this year and subsequently, those cash levels have built up again. Now, we do have a high cash level at the moment. It's roughly half of the portfolio. Fortunately, now cash is earning us more than it was, say, 5 years ago, which was effectively nothing. Now, some of that may go back into the market at a limited expense, but we're certainly much more cautious with our positioning and with things that aren't behaving coming out of the market. So we think that we're working our way towards, while we may not be there quite yet, certainly the risks are building in our view or in the system, and we're getting closer to a more difficult environment. And I think almost everything we're seeing at a macro level would suggest warning flags. Not necessarily that it's all over now, but that we're moving closer to that point.
So I know every approach and every investment manager has got, when they've got strong beliefs about the markets, sometimes the market will surprise you and do the opposite of what it should have done, in inverted commas. What times are there when you've been applying this philosophy and a call's gone against you? What did you take from it?
Yeah, look, a good example of that would have been October 2023. So we had started to move money back into the market and we were positioning for growth. In October, the market kind of rolled over and started to look like it was breaking down, and we quickly raised cash levels back up there. When the market broke down, it basically turned around again within a week and started breaking up to that, and it didn't stop. It didn't turn around. We were very quick to come back in, but a similar sort of thing has happened more recently, right? So 2023, market wasn't doing what we expected, so we raised some cash, and we weren't just kind of like blinkers on going with the market no matter what. With the share market, you always have to assume there's something going on you don't know about. Whereas more recently, in March 2026, share market starting to deteriorate. It's turned around on a dime and basically flown, certainly the US market, off the March lows. We haven't been anywhere near as quick to put money back in this time, just because we see the risks materially higher. And I guess that comes back to focusing on capital preservation. I think you always just have to look at the current situation and make your best assessment of the risk. I mean, there's a risk of being in the market. There's a risk when you're out of the market. It's about using, I guess, the cycle to dictate when we should be going with the flow and when we should be holding back.
Looking at for everyday investors then, what mistakes do you see people making?
The most common for everyday investors would be jumping on the current theme or fad, if you like. The market has a way of attracting money to a story. I mean, I guess at the moment it's been semiconductors and hyperscalers and these sort of things that had a huge run. At the end of last year, it was silver and gold. There's always sort of something, then it was AI before that, and there was lithium sector before that, and there's uranium had its time in the sun. I think falling in love with a narrative, because some of these trends can last for years, but I've always tried to have a bit of a balanced approach to an investment portfolio. Like, don't put all your eggs in one basket. You want to be, to a certain extent, spread across different asset classes and certainly different stocks. It sounds logical, but you'd be surprised how often we see very, very focused for people that are running their own money, very, very focused, narrow, one, handful of investments, or it's all focused in one sector because that's what's doing well. And what typically happens is, what I've seen a lot is they fall in love with the story and the narrative and on the way up, and then just hold it all the way down when it's gone the other way or gone out of favor. And it can be quite a stressful investment journey when you're investing like that, if you want to call it investing. So I would say silver was a really great example. At the end of last year, silver price had doubled, and basically doubled again. And all of a sudden, people that aren't really investors or that interested in it, all of a sudden wanted to talk about silver to me. It got to the point where everyone was talking about it and wanting to own some physical silver and these sort of things. You just got to be really careful, I suppose, about jumping on when everyone else is talking about something. I'm sure that even though I wasn't around in the dot-com boom, it would have been the same with dot-com stocks. Everyone talking about how much money they'd made in dot-com stocks. It definitely happened with the resource stocks in the 2000s when I started out. Bitcoin and crypto, there's plenty of people that we've seen and who have fallen in love with that space. And, I guess there's certainly been some significant money made, but there's been a lot of people come late into some of those, I guess, investments and hold them all the way back. And, like Bitcoin's halved, but there's 999 others, probably more, that have fallen a lot more than that in the last little bit.
Yeah. So if someone can't hire you or invest in your fund, what's one or two things from your approach they could genuinely borrow?
A couple of the books that we've talked about, like Phil's book, The Secret Life of Real Estate and Banking. Akil's book, absolutely, just to give a bit of a background and framework on how this all works, how the economics and finance and shit, it ties together with real estate and the share market. I also think Phil and Akil's property share market economics subscription is a really good education tool. It explains what's happening in the world at the time and ties it back to the cycle, but it also teaches you how to read a chart. And for someone who's not, deeply connected with what's going on, it can be quite dangerous at times just to be going off what you read in the paper. By the time it gets in the paper, it's in the price, right? A lot of the time. So it just gives you some very valuable tools to help you navigate the noise and to try and understand yourself what's going on, rather than just relying on your traditional mainstream economists, which, like pretty typically they're all saying the same thing at the same time, which, at critical turning points is very rarely what you need to hear.
No.
So that would be my two suggestions. You're welcome to sign up to our database in terms of you can just see what we're doing, read our quarterlies, they're all public. They can give you some ideas about what we're doing, which may help with your own investment. And probably the last thing is find yourself a financial advisor who looks at the world, understands the cycle, and looks at the world and is prepared to help manage your assets to effectively preserve them during those acute periods. Those acute crash type periods are when a lot of the damage is done. So if you have an advisor that can help preserve some of your capital in those periods and also not pull your money out right at the wrong time, those sort of simple things can make a huge difference over the long run to your outcomes.
Tim, where can people find out more about you and the work that you do?
Look, Oakleigh, so Oakleigh, fs.com. There's an investment management tab. You should be able to sign up to the website and get on the newsletter. And if you're local in Australia, you can put in an inquiry for some more information and someone will contact you.
Brilliant. Tim, thanks so much for your time. Really appreciate it.
Thanks, Jonathan.
Thank you for listening to the Shepheard-Walwyn podcast. To explore these ideas further, be sure to visit our website www.shepheard-walwyn.com and join our mailing list for news and special offers. Check out our authors and buy the books to learn more. And you can also find us on social media. Links are also on the website. And if you like the podcast, please head over to iTunes or Spotify to give us a review. It's surprisingly helpful in getting the ideas out there. So until next time, keep reading